Accounting Standard 11, Foreign Exchange Rate, or the effects of changes in foreign exchange rates. So in this accounting standard, we will see what are the fundamentals of foreign exchange. We will see what is forex arithmetic. We will also see what are the foreign exchange terms which we use: value date, cash ready, TOM, tomorrow, this tomorrow's rate, spot, what is spot rate, what is forward rate, premium and discount. We will see what is forward exchange contract. We will also see forward point. We will see initial recognition of foreign exchange contract, integral and non-integral operations, exchange differences, accounting standard in this regard. So first off, we'll start with what is fundamentals of foreign exchange. So it's a general mechanism by which banks convert the currency of one country to the currency of another country. That is basically the fundamentals of foreign exchange. Now, how it is done? Suppose we have an exporter from India selling goods in the European market. Hence, exporter will send goods to a European country, and the importer in the European country pays for those goods once it reaches them in their local currency, that is euro. However, the exporter may require payment in his local currency, and that is where the foreign exchange banks come to the rescue, who may convert the euro from the importer to Indian rupees and gives it to the exporter. Hence, foreign exchange is relating to foreign trade. Hence, there are fundamentally aspects in the foreign exchange mechanism, including the following facts herewith for foreign exchange, namely, every country has their own legal tender or local currency. That is what the exporters use to send goods. It brings in foreign currency, which the importer sends him. In the exchange from one currency, here foreign currency is euro, to another, here local currency is rupees, is put through banks by means of bookkeeping entries in the two centers concerned. Next, credit instruments. So credit instruments are used to make effective the exchange of one currency to another. So these many things are involved in the case of foreign exchange, or when we discuss fundamentals of foreign exchange. So in India, in the forex market, that is the foreign exchange market, there are restrictions placed on free flow of capital into and out of the country. Before LERMS, or Liberalized Exchange Rate Management System, the Reserve Bank of India used to fix the buying and selling rates, and the forex market would remain within a ceiling and floor, which is also fixed by RBI. However, currently the local interbank market drives the exchange rate according to the forces of demand and supply. So this gives you an introduction or some fundamentals on foreign exchange. Next, we'll see what is forex arithmetic. So this is forex arithmetic. We have a direct quote here, which says US dollar 1 is 78.955 Indian rupees. And there is an indirect quote, which says US dollar 1 is euros 0.9567 selling and 571 buying. So this is an indirect quote. So by chain rule or cross rule, we say 0.9571 euro is US $1, or 1 euro is $1 divided by 0.9571, or $1 since it is 78.955, it is 78.575 divided by 0.9571, which we get it as $82.09. So this is basically chain rule or cross rule. Now let us go and take a look at what is foreign exchange, some of the foreign exchange terms which we commonly use. So first off, we start with what is value date. Value date is the date at which the exchange of currency takes place in foreign exchange. So it is the date in which the exchange of currencies takes place. Now what is cash ready? Cash ready is the rate when an exchange of currencies takes place on the deal's date. So whenever there is a deal which is happening on a certain day, whatever is the rate when an exchange of currencies takes place is actually cash ready. Now, what is TOM? TOM is tomorrow's rate, which is nothing but the exchange of currencies at TOM rate takes place on the next working day of when the deal is made. So if the deal is made today, tomorrow, whatever is the rate is the TOM's rate or tomorrow's rate. Spot. What is spot? When exchange of currencies takes place at the second working day of when the deal was made, it is spot rate. So it is the second working day of whenever the exchange takes place to whenever the deal was made. So it's the second working day, or that is spot rate. Forward rate. If exchanges of currencies takes place after a period or some days after the spot date, it is forward rate. So it is generally represented or indicative of premium or discount for the forward period. So we know that spot rate is basically in the second working day. Any rate which happens after that is a forward rate. Now, what is premium or discount? When the currency is valued more or costlier for a value date in the future, it is said to be at a premium. Otherwise, it is said to be at a discount. When the currency is valued more or costlier for value date, it is premium. Otherwise, discount. Now, next is forward exchange contract. Forward exchange contract is the exchange rate for settlement on a date which is beyond the spot rate, and hence there is a period that may have elapsed after the spot rate is when a forward exchange rate is quoted. Forward exchange contracts are over-the-counter foreign exchange contracts involving currencies not locally traded in US markets or European markets. Forward contracts are contractual agreements between two parties to exchange a pair of currencies at a specified time in the future, normally at forward rate. Now, next we'll see what is forward point. So let us assume that there is a spot rate of US to Euro, which is Euro 1 is US dollar 1.0448. That is the spot rate. Now, exchange rate 3 months forward is Euro 1 is US dollar 1.0530. So the exchange rate, which is a forward rate because it is after the spot rate, which is there is a gap of 3 months, and then the rate is quoted, which is quoted at 1.0530. So you see there is a difference between this exchange rate 3 months forward, which is US 1.0530, and the spot rate, which is 1.0448. So the difference between 530 and 448 is 82 points, which is our forward point. Hope that is clear. Okay, now let us take a look at what is initial recognition of foreign exchange contract. A foreign currency should be recorded in the initial recognition of the reporting currency by application of the foreign exchange rate at the date of reporting between the reporting currency and the foreign currency. This is to be done when an enterprise buys or sells goods or services denominated in foreign currency, borrows or lends funds whose amount payable or receipts are denominated in foreign currency, becomes a participant in an unperformed foreign exchange contract, or acquires or disposes assets denominated in foreign currency. So a foreign currency should be recorded at the initial recognition of the reporting currency. This is to be done by the application of foreign exchange rate at the date of reporting between reporting currency and foreign currency. So that is basically the initial recognition of foreign exchange contracts. Next, we'll take a look at what is integral and non-integral operations. For the sole purpose of accounting treatment, in this case foreign exchange rates and its changes and effects of changes, the transactions can be classified as Category 1 foreign currency transactions, Category 2 foreign operations, and Category 3 foreign exchange contracts. Now let us see what each of them means. Foreign currency transactions. So foreign currency transactions covers buying and selling of goods and services, disposition and acquisition of assets, denominated in foreign currencies and lending and borrowing of foreign currencies. Now, what does foreign operations cover? Foreign operations cover transactions in a foreign branch having to do with associates who are foreign, joint venture with a foreign bank, as well as foreign subsidiaries operating in India. For the purpose of accounting, this is further classified into integral and non-integral operations. So what basically is non-integral and integral operations? It is foreign operations which covers transactions in a foreign exchange bank. So describing integral and non-integral foreign operations, integral foreign operation is a foreign operation which takes place as if it was an extension of the reporting enterprise activities like sales depot, foreign arm or dependent branches which produces raw materials and transfers it to the head office, or when foreign operations raises finance to help such reporting enterprises. The transactions are translated as though the entire transactions are done by the reporting enterprises. So here we have the concept of foreign operations as well as reporting enterprises. The transactions which happen are entirely translated as though the entire transactions happen by the reporting enterprises. This would mean cost and depreciation of tangible fixed asset is translated using exchange rate at the date of purchase of the asset. The rate used should also be at the rate at which any valuation of tangible fixed assets be made. Cost of inventories and realizable values should be properly translated at the closing rate. Exchange differences arising as a matter of translation of integral foreign operations financial statement should be charged to profit and loss account. Now, how the non-integral foreign operations are taken care of. So in this case, the non-integral foreign operations, activities of foreign operations takes place independently of the reporting enterprise. So here also we have foreign operations and reporting enterprise, but the activities are very independent of each other. Transactions of reporting enterprises are not much of what exists in non-integral foreign operations. From local borrowing or operations, activities of foreign operations are financed. So basically from local operations, the activities are financed. The currencies of foreign sales are mainly not in currencies of the reporting enterprise. Accounts of non-integral foreign operations are translated in such a way that closing rate is applied to balance sheet items for both assets and liabilities. For items of income and expenses, actual exchange rate on the date of transaction is applied. Also, the standard allows application of average rate subjected to materiality. So this much is the difference between integral foreign operations and non-integral foreign operations. Now let us take another topic, which is exchange differences. What do you mean by that? Exchange differences. Exchange difference is the difference of reporting the same units of foreign currencies in the reporting currencies at different exchange rates. So it's the difference of reporting same units of foreign currencies in the reporting currencies at different exchange rates. Reporting currencies may actually differ. This standard does not deal with exchange differences arising from foreign currency borrowings to the extent they are regarded as adjustments to interest cost. However, this standard is applicable to exchange differences on all forward exchange contracts. Lastly, we'll see what is the accounting standard in this regard. So the disclosure include amount of exchange differences in net profit or loss for the period. It also includes as a separate component of shareholder funds what is net exchange differences accumulated in foreign currency translation reserve. Reconciliation of amount of such exchange differences at the beginning and end of the period is also included. The reason for using a different currency should be disclosed when reporting currency is different from currency of the country in which the enterprise is domiciled. So that is what most of the accounting standard foreign exchange rates actually mandates. Thank you.